The Nigerian National Petroleum Company is poised to adhere to a stringent 30-day repair timeline for the Port Harcourt refinery, a move that signals its commitment to stabilizing the national petroleum supply. However, any delays in this timeline could exacerbate existing supply chain challenges, potentially leading to further disruptions in the market. In a significant regulatory development, the Nigerian Communications Commission has instituted new mandates requiring telecom companies to proactively notify consumers about service outages and their underlying causes. This initiative is aimed at fostering transparency within the telecommunications sector, ultimately serving to enhance consumer trust and satisfaction. Meanwhile, a novel air cargo initiative linking Nigeria with East and Southern Africa has emerged, promising the potential to slash logistics costs by an impressive 50%. This groundbreaking effort is designed to facilitate inter-trade activities and significantly improve connectivity for Nigerian businesses, which is essential for economic expansion. However, the current economic landscape presents formidable challenges for manufacturers in Nigeria, characterized by persistently high inflation and interest rates. These economic conditions complicate efforts aimed at bolstering local businesses, which are essential for sustaining growth and fostering a resilient manufacturing sector. In this context, the government's role as the largest infrastructure spender comes into sharp focus, as it plays a critical part in the success of the Buy Nigeria initiative. Increased public spending on locally produced goods can not only enhance competitiveness but also stimulate job creation, thereby contributing to broader economic objectives. The ultimate efficacy of the Buy Nigeria initiative will hinge on the government's purchasing decisions, particularly within pivotal sectors such as automotive and construction. Early indicators of commitment, such as substantial procurement of local products, will be vital in assessing the initiative's overall success. On a broader scale, the current debt capital market is witnessing a downward trend in interest rates, creating a favorable environment that is expected to continue into the next quarter. This development holds significant implications for long-term savings and borrowing strategies across various sectors of the economy. Nevertheless, inflation remains a pressing concern for both firms and households alike, predominantly driven by rising energy prices. A nuanced understanding of these inflationary expectations is crucial for accurately forecasting future economic conditions and crafting effective policy responses. Moving forward, a gradual easing of interest rates is anticipated. However, this process necessitates meticulous management to avert excessive liquidity that could undermine the stability of the naira. Such an approach aims to strike a delicate balance between fostering economic growth and maintaining currency stability. In the current climate, the high interest rates in Nigeria, ranging between 30% to 32%, present considerable opportunities for cash-holding investors. This environment encourages strategic capital allocation, allowing stakeholders to capitalize on prevailing rates while they remain attractive. Concurrently, the banking sector is exhibiting signs of adaptation to evolving economic realities, with interest rates gradually easing from their previous peaks. This transition enables banks to foster more competitive lending dynamics, thereby enhancing access to capital for businesses across various industries. The ongoing push for local content in the manufacturing landscape holds the potential to drive significant economic growth. Yet, for effective implementation and meaningful job creation in Nigeria, a comprehensive and focused fiscal policy is paramount. The cotton industry, once a major employer in Nigeria, is undergoing deliberate efforts to restore its former prominence. Revitalizing this sector is crucial, not only for preserving employment but also for achieving broader economic diversification. In alignment with this revitalization effort, the government has demonstrated a commitment to supporting the cotton sector through various strategic programs and stakeholder engagements. Such initiatives signal a positive shift in policy direction, underscoring the necessity of collaboration with farmers to ensure sustainable success. An emphasis on quality and agronomic practices emerges as a cornerstone for enhancing Nigeria's cotton production, particularly when benchmarked against competitive global producers like Egypt. Achieving success requires a concerted focus on effectively managing the entire value chain, from seed cultivation to garment production. On a global scale, India and Pakistan's status as significant consumers of cotton highlights the robust demand for this essential fiber. Such demand is instrumental in sustaining the textile industry, further indicating the economic implications of cotton production. Moreover, the ongoing discourse regarding the competitive dynamics between cotton and polyester underscores the challenges presented by alternative fibers. Nevertheless, cotton's inherent versatility ensures it retains a vital role across multiple sectors, reinforcing its economic importance. The diversification of the economy through textile production vividly illustrates how cotton contributes to various sectors, including valuable byproducts that enhance its overall worth. This diversification is not merely advantageous, it is crucial for fostering sustained economic growth. In discussing the cotton value chain, its substantial economic potential for Nigeria becomes evident, positioning the nation as a prospective leader within the industry. Such possibilities warrant careful consideration and strategic planning. As the narrative unfolds, the video touches upon forthcoming U.S. economic data releases, including GDP figures and inflation trends, which are expected to significantly influence market sentiment and shape global economic policies. Further complicating the landscape, China's strategic efforts to maintain its position as a global manufacturing leader, particularly in high-end technology goods, present notable challenges for other nations striving for economic advancement. In Europe, Germany's bond yields have experienced an upward trajectory, with a 10-year yield rebounding to 2.6%, signifying a recovery from previous declines that were largely influenced by tariff uncertainties. Similarly, Italy's bond outlook has improved following Moody's recent rating upgrade, contributing to a modest increase in its 10-year yield. This development reflects a more optimistic economic forecast, suggesting increased confidence in Italy's fiscal trajectory. Lastly, President Trump's decision to postpone the implementation of 50% tariffs until July 9 has had a pronounced impact on market dynamics, particularly affecting major players in the automotive sector such as German manufacturers Mercedes-Benz and BMW.
Morning, your daily dose of economics, markets, and what's driving sentiments right there in the world of business. It's the first trading day for the week. Let's get you the top stories that get you ready for that first trade that you're going to make this week. Starting off with oil prices now. We're seeing oil starting off the week in the green today. Gained an early Asian trade after U.S. President Donald Trump extended the deadline for trade talks with the European Union, easing concerns about U.S. tariffs on the bloc that could hurt the global economy and fuel demand. And we're seeing that impact there, 0.25% up, $64.94 a barrel. That's for Brent. I'm trying to get back to that $65 level. Then we see WTI, not left out, $61.70 a barrel. There's a nice push higher in crude and oil and U.S. equity futures this morning after U.S. President Donald Trump extended the deadline. So we're seeing tariffs again, driving sentiments in this market. All right, to other matters now. The Petroleum Products Retail Outlets Owners Association of Nigeria is charging the Nigerian National Petroleum Company to adhere to the scheduled 30-day repair timeline for the old Port Harcourt refinery in order to minimize disruptions to petroleum product supply. The body, in a statement by its public relations officer, Dr. Joseph Amobele, expressed concern over the recent shutdown of the refinery. He also says the association fears that the 30-day schedule might not be realistic due to usual bottlenecks, potentially leading to further delays and exacerbating supply chain challenges. Petron is also worried that delays in the refinery's 30-day rehabilitation schedule may worsen economic hardship for millions of Nigerians and will have a negative effect on the business of Petron members who have bought millions of liters of petroleum products from the NNPC refinery depot. And now to communications. Now we see the NCC, that's Nigerian Communications Commission, they've issued a new directive requiring all telecom licenses to publicly let the consumers know about major service outages, including their causes, affected areas, and expected restoration timelines. The Commission disclosed this in a statement signed by the Acting Director of Public Affairs. That's Mrs. That's one of the operators there. According to the NCC's new directive, mobile network operators must use media channels to notify consumers during unplanned service disruptions. Additionally, in cases of planned service outages, customers must be notified and at least 1 week in advance. So definitely big rules there for most of these telecom operators. We'll see how they manage to adhere to this. So as a consumer, expect to hear when maybe a service outage will be coming up. You definitely will hope they can stick to that. Well, the federal government, in collaboration with the United Nations Development Program, have begun airlifting of cargoes from Nigeria to East and Southern Africa. Speaking during the flag-off ceremony at the General Air Traffic Terminal of the Nnamdi Azikiwe Airport, Minister of Industry, Trade and Investment, Mrs. Jumoke Oduwole, says this initiative offers a 50% reduction from commercial rates. Our correspondent, Kumbi Buluwade, reports.
It's the inaugural launch of airlifting of cargo from Nigeria to East and Southern Africa. To witness this at the Nnamdi Azikiwe Airport is the Minister of Trade and Investment, the Controller General of Nigerian Customs Service, among other dignitaries. This is an initiative by the federal government in collaboration with the United Nations Development Program to promote inter-trade among African countries and enhance connectivity.
For far too long, Nigerian exporters have faced steep logistics costs and long delivery times when they trade with their African partners. Today marks the delivery of a campaign promise for President Bola Ahmed Tinubu GCFR's administration to Nigerians in our collective effort to optimize the African Continental Free Trade Area for Nigerian businesses. This corridor is framed by special rates that are currently 50% lower than the commercial rates and are applicable to Nigerian businesses that are members of umbrella business groups in Nigeria.
Today we are not simply launching a new trade route, we are unlocking a new era of African commerce. This corridor is more than a cargo in motion. It is a movement. A bridge connecting Nigeria to East and Southern Africa, a signal that Africa is no longer waiting to be invited to the global trade tables. We are building our own.
Collaboration and synergy among critical stakeholders is highlighted by the Customs Controller General, who harps on the need to ensure the smooth running of the initiative.
The success of this flag of today of the corridor requires collaboration beyond Nigeria Customs Service. It will require the assistance and the collaboration of all the agencies that are involved, not just Nigeria Customs Service, the Federal Airport Authority, all the other regulatory agencies, NAFDAC, and all of them. We hope that we will see this as a window of opportunity to facilitate trade.
With the speeches rendered, it's now time for the loading of the cargoes from the terminal into the aircraft. With a total of 4 companies who have shipped their products through this inaugural flight, it's expected that this initiative by the federal government will help reduce logistics costs for Nigerian businesses and improve their growth. Kumbi Buluwade, Channels Television News.
The African Development Bank Group's 2025 annual meeting that kicked off today in Abidjan, Côte d'Ivoire. And the theme of the meeting is making Africa's capital work better for Africa's development. Our business editor, John Mekwa, is right there.
The final week in the month of May 2025 is a memorable one for the African Development Bank Group. It's a week that they're having their annual meetings for this year. So for this week, it's going to be a very busy one with delegates of over 6,000 comprising heads of state, representatives from the private sectors, the NGOs, and everyone, in fact, will gather, everyone of importance that is, will gather in Abidjan to make some decisions. So the conversation will be around the theme for this year, which is making Africa's capital work better for Africa's development. But the climax of the meeting for this week is that the group is going to elect a new president as the tenure of Dr. Akinwumi Adesina comes to an end. And I'm here for Channels Television to give you the details of all of the meetings.
All right, that's John Mekwa, and she's right there in Abidjan to bring us all the information of what's playing out right there at the AfDB general meeting. That's for AGM, that's the annual general meeting, that's for 2025. We'll get details later on Business Incorporated from John Mekwa. But we'll take a break now. When we come back, we'll find out how to push this Buy Nigeria mantra. That's the moment. Just stay with us. with the latest push for Buy Nigeria and to boost production in the country. Let's find out how this can work. You know, despite macroeconomic headwinds, we're still battling with high inflation, high interest rates in the country. We've heard organized private sector talk about how hard it is to make profit if you're taking a loan at about 37 or over 30%. Definitely a tall order there. But joining us to discuss, we have Mr. George Nofowoka, as the MD CEO, Common Wires and Cables. He's joined me right here in the studio. It's great to have you.
Morning.
Morning, sir. Yeah, so definitely, I love the sound of that, you know, Buy Nigeria. But, you know, definitely it will take a lot.
Correct.
To make that happen. And, you know, we've seen the usual issues, you know, at this time. High inflation. We see the inflation numbers for April, even though it's the rebased data, 23.71%, food inflation, 21.26%, core inflation, 23.39%, and they're much lower than what we're used to, you know, before the rebasement. Then we have the May decision, that's for the MPC, telling us how much it will cost for you to get a loan, you know, from the bank. And we see that it was retained at 27.5%. And, you know, definitely we know organized private sector is saying, you know what, we want lower rates. But the CBN is trying to battle inflation. How do you balance all of this?
Okay, first of all, on the issue of Buy Nigeria, I think that's commendable from the side of the government, especially from presidency, that we finally have an executive order, an approval from the Federal Executive Council headed by the president to actually have that in place. Good policy implementation will be key. What the Bureau of Public Procurement does and how they manage it, because from everything that I said, they are supposed to manage it for us. And how to manage it for the government really will be the key. The government still happens to be the biggest infrastructural capital spender in the country. So if they spend in infrastructure, and if the capex spent on infrastructure goes in the direction of Buy Made in Nigeria, you definitely would see a rise in the competitiveness of locally made goods. Because the more volume you give them, the more adequacy they actually get into, the more competitive they get. And the good thing about it is that it's there to drive jobs. If I know fully well that the government will patronize me for either my cars, for cables made in Nigeria, or for steel, cement, definitely we know we buy made in Nigeria. Those are the things that will be the driver for the economy going forward, where you tend to see so many government-related contracts that end up with a lot of importation, which is very sad. Even simple places like TCN, if you look at it, the amount of areas that they can look inwards, which they've done in the past, but really, what is the percentage of transmission that we actually buy local? What's the percentage of distribution that we buy local? And those are the key things that let's wait and see. You know, for me, it's always good initiatives, but the good initiative, you only tell the tale of a good initiative in the implementation of the good initiative.
I'm talking about Buy Nigeria now. Are you seeing any signs that the government, on the government side, they're actually pushing towards buying Nigeria? Are there any signs?
I'm sorry, it's too early to say. Sincerely, this thing was actioned 6th of May, and we're looking at, I think the first criteria we'll see is when they start buying cars in Nigeria by the government. I think that's the first thing most agencies tend to easily grab hold of. Is vehicles. Where are they going to buy? Innocent? Are they going to buy GAC? Or some of the other locally manufactured or assembled car companies? If they go that direction, then we'll start seeing immediate impact. Then the rest will fall in place. If we then take those type of things into what you were talking about, interest rate, inflation, and then we tail back into that, the impact element of that is, it's also positive. But where are we at inflation? Inflation at 23.71, which you said. which is easing. Let's be fair, it is actually easing. We're coming from a 24.23 down or 53 to where we are now. We're about 0.52% down, which it shows it's easing. Now, we've had two MPCs that actually have held rates, which were my position, that they would hold rates. Now you wonder why, where the drive really, and for manufacturers, we need reduced interest rate, but you have to be sometimes fair on who manages the macro side of the economy. Is trying to balance inflation, FX positions, and interest rates, which are indicators that literally those three, they need to converge for you to actually start saying it. But I knew, and for me, it was a fact that you won't see a rush to a reduction in interest rates. I think for us, looking at 2025 as an indicator for any manufacturer, it will be for the government or for those managing the monetary policy of the country and the macro side, which is the central bank and the rest of. I foresee that, and which is what I said from the beginning of the year, they'll be looking for more like stability rather than a guarantee to push towards a lower interest rate, the currency that would have appreciated. I see that for 2026. I do not see the drive yet. We need it, not to that. But the whole economy is tilting towards that. If you look at it today, if you look at the debt capital market, the commercial paper, the bonds, it's tilting down. So interest rates at the end of quarter 24 in the CP market was going as high as 31, 32 for a 270-day position. Today, we have interest rate tailing down to about 24, 25, and it's still tailing down. Now, so the reality is that most people are taking long positions on savings, but they're taking short positions on debt capital because everybody's seeing debt capital as something that is going to tail down. Now, the real side is that we want debt position in the double digits, lower double digits, which we basically in their teens. So 15, 16, 17, 18, and we need that in the teens, not in the 20s. But it will tail down as we see inflation tailing down. Now, we will be all looking really towards the next MPC. The current one was a bit predictable. Is
the next one predictable, in your opinion?
For me, they can't hold the next one. They've held twice.
Okay.
Then you have a situation where inflation is tailing down and it's easing. There's no excuse to hold a third one. And they cannot increase, let's be frank. So holding a third one literally will be shooting all of us in the foot because the expectation is by the time you're entering third quarter, we should start seeing an easing of interest rates. So it is the same expectation. The market is already driving it, whether the CBN likes it or not. We're already driving it. If I'm going to the market today and I'm going at the market below MPC, I'm going closer to Treasury bill rates, then it tells me that, look, the market pricing is not right, it's distorted. Same thing with, if you look at it, let's be fair, even the Naira real value today is not 1625. We all agree it should be tailing down to the lower 1500s. But I think everybody is trying to let everything lie in its own way to try and manage the expectations of what each individual area of it, from inflation to interest rate, FX position, how it actually influences all our decision making.
And talking about expectations, we did see the survey from the central bank there, and talking about firms and households, the expectations of what's going to drive inflation. Energy, that was number one. PMS, diesel, 91% of firms said that's what's going to drive inflation. Correct. 88% of households says that is their concern, for inflation. And you have the exchange rate, transportation costs, interest rates came in at, I think, number 4. 84% of firms say yes, that's driving up inflation. 80.9 households. I guess households don't really care for interest rates. Then, talking about the next meeting, at this point, you said they cannot hold. Again, that's the MPC can't hold.
They can't.
So if a cut is going to come, what should be the cut? Should it be 50 basis points or 100 basis points?
It would not be aggressive. Anybody looking for an aggressive cut now basically is saying that they're still not managing the expectations. It will be a slow but steady. I don't see more than a 0.5 taking off, and then a gradual process. If it's aggressive, I think it will tail back into you. As you're trying to balance interest rates, you must also try to balance the actual demand flow of money. So you really don't want the demand flow and the liquidity to be too eased for you to and I have another run on the naira. So, which basically means you are going to have an FX issue again. So in order for you to forestall that, you will ease that gradually. Now, the expectation, which is the simple basic economics, is you cannot have a steady continuous rise and a quick ease. It would not happen. So the expectation would be a steady ease over each MPC.
Maybe 25 basis points.
25 basis points sincerely would not be acceptable to the market, because I think we've held so long. And then you have to look at it between now and the next MPC. Most likely you're going to see further easing of inflation. Now you get another from April. Now from April to May, we've got, from March to April, we had a 0.52 reduction on inflation. Most likely, if you look at what is happening today, yes, things that are driving inflation the most will be energy prices, petrol, diesel, and the rest of them, and also energy and power. Now, power has been stable, so let's hope we don't get the government talking about the subsidy removal on power from 209. And if they remove the subsidy on the power now, you get another price increase. Then you have another inflationary push. Now, if that is not happening, and we're just looking at where we are on power, looking at where we are on prices of energy in terms of petrol and diesel.
All things being equal.
All things being equal, we have no big push for inflation at the moment, unless you can see oil push up to $80 a barrel and naira push downwards. If oil stays where it is, within the range, plus or minus $5, I think we should be seeing where we are at the moment, which will be manageable inflation rates. And then we'll be seeing turning down of those interest rates. So interest rate will definitely fall. Now, it's two ways now for anyone. To the manufacturer, where it's literally happy we're going the right direction. To anybody investing, which is what is also delaying this thing, from the FPI perspective, from the investors' perspective, where people are putting in money into Nigeria or into savings, there's the easing of your interest rate also might slow down their investment appetite for the Nigerian treasury bills or for any bond or for any debt capital market. Now, but if and only if that is that slowdown. But the good thing about it is that the slowdown happening and the easing of interest rates in Nigeria is the same easing happening all the rest of the world. Now, so invariably, we still keep the same margin of investment and interest. So you would not see a total exit. You will see a marginal reduction, but you still see continuous interest. Because look at it. If you come to Nigeria today, you pick up a treasury bill at around 365 days at about 24, 25, and you pick up secondary market at maybe 23. You can also pick up even lower. Now, but you're having a 20% basis. Now, anywhere in the world, there's no way you can get 20%. Even if you take the exchange rate issue, which is the exchange rate risk, which has to be factored into the risk of your investment. If I come into Nigeria today at 24%, and I take an exchange rate risk of between 150 to 165, you're talking about 3%. 3-4%. So if I take that off my basis of my 24%, even take 4%, I'm still landing at 20%. Take it off the capex, most likely it takes off about another 2% of your capex. You're taking a 6% off court. A 6% off court of your interest yield of 24% is 18. There's no place in the world any FPI can get that type of money. So Nigeria is still a sure bet for most portfolio investors in this country.
For the hot money.
It's
at this point.
It's a good place for anybody saving. I still am the keep your naira. Enjoy the interest rate while it lasts. When it starts easing, then pump it in. But at the moment, is everybody that is in the cash is in the money. Anybody that doesn't have cash might be in the negative because the borrowing cost is high. Although the borrowing cost is high, we've moved away from, let's be fair, the commercial banks did not get business at 36. They did not see business. Today, I'll say interest rate in Nigeria today has eased back to about between 30 and 32 at the top end. The lower end is really, you'll be shocked to find that the bank, as much as CBN's rate is 27.5, which is the MPC rate and the MPR rates, the reality is no bank is lending more than, at top end, they're ranging between 28.5 to 30%. And so, because it wasn't realistic anymore, and the market could not be moved, it was not moving in the right direction.
That's coming from a time of about 35.
Yeah, they have come down. Let's be fair on the commercial banks. They have come down. And I think as they see the interest rate coming down, they're also being a bit more, I think the banks, let's be sincere, actually being a bit more dynamic in how to create lending and create funding dynamics that is acceptable and competitive. We've gone away from when banking was all about sit down and just do whatever you want to do and get away with it. Your business will not thrive. And the type of indices the banks are declaring now, I think it's not as easy as before, where if you declare almost next to nothing, nobody cares. The figures on PAT and indices on ratios are now so expectantly high, they must perform. Now, the non-performing loans might be a little bit high, so they have to be very cautious. That the reality is, as I was talking to one of our banker friends, said the reality is at the end of this year, the forbearance that the central bank has given all the banks to cover some of their non-performing loans will end this year. So by the end of 2025, all of us will know really how much non-performing loans exist in this system. Right. And so I think now the cautious approach by most of the banks is to make sure clear up their books. But the key thing for most manufacturers, and I think the key thing is that the drive for local content would help massively if the policy to back it, fiscal policy to back it, and the political will to back it actually is seen by everybody in every ministry. It shouldn't be talk shop at FEC, and then after the talk shop, lovely news for 1 week, 2 weeks, 3 weeks like we've had. Question is implementation. And really, the success story of that will be the quick revival of the economy, will be the quick GDP upside, would also be the quick wins for the government in terms of creating employment, creating jobs, creating stability within the system. Because those are the things that drive. If you are the biggest, if you look at the percentage of the budget that is spent on capital, and you then make even just 20, 30, 40% of that a guaranteed local content, it's trillions of naira embedded. And the more you push the levels of that capex infrastructure spend into 50, 60%, 70%, it changes the dynamics of where and what we can do with this economy, what we can do with growth in industry and manufacturing, and how we can guarantee the jobs that are being created in the country.
I guess, at this point is, buy Nigeria yesterday, at this point, from
yes.
The government side and to the people. And we're seeing what's playing out in the global space with tariffs. I know you're into the export business, so I'm sure you get nervous sometimes with some of those tariff calls. Then we also see President Trump trying to, push most of the big producers in the U.S. to come and set up shop, their production shop right there, manufacturing in the U.S. Bring all those jobs back in, not taking it to India or China.
I think it's an impossible task. Let's be fair. Look, Trumpism, or whatever we call it today, it's really is an ideology that is literally impossible to achieve. We have had over 100 years of globalization. You're trying to tear the rule books of what you've done for 100 years overnight. I think it's impossible for them to achieve because look at it. The mere fact that today, the same globalization created China as a global hub for industry. But today, China is also struggling because cost to labor is high. So what is China doing? It's actually moving out of China.
So China is moving out of China.
So the reality is, look, the cost to labor in the U.S. is not practical for some of the things they want to do. It's like saying you want to go and start making fabrics in the U.S. The cost to labor for those things that have been done in Bangladesh, in Pakistan, is literally impossible for you to achieve that cost to labor and cost to efficiency of those production in the U.S. So it is not everything that you can produce in your country. We need to be factual that. So for me, it's
an ideology.
It's a fantastic ideology. It looks good.
But
everybody will come back to the playing field later on, and this thing will die a natural death.
Fantastic. It's always great having this conversation.
Thank you.
With you. That's Mr. George Onofo-Walker, the MD CEO, Coleman Wires and Cables. Thank you for coming on.
Thank you, Laddie.
All right, we'll take a break now. When we come back, we'll get a sense of what's happening with cotton production in Nigeria and what's happening in the global market. That's in a moment. Just stay with us. All right, now to our next conversation. Cotton has long held significant potential as a driver of economic growth and industrial development in Nigeria. But as global demand in textile and apparel products continue to rise, Nigeria's cotton industry stands at a critical crossroad, poised for revival, but facing structural and policy challenges. Now, let's aim to explore key issues surrounding cotton production and the business right here in Nigeria. Joining us to discuss this, we have Ms. Ololade Adene. She's a Managing Director, House of Dockers Integrated Service. It's good to have you on the show.
Thank you. I'm happy to be here. Thank you for having me.
So I guess, we know cotton is really, really important, definitely for textile and all of that. And we used to be a big player in the market. If we look at, today's market, we're seeing the likes of China, leading with global production of 26%, 32 million bales. That's what they produce in, I think, 2024. India, they come in second with 25 million. That's 21%, of global production. We see the likes of Brazil 17.0 million, 14% of global production. So, it's the usual suspects, right there. Nigeria should be.
We should be.
On that list. How are you seeing the cotton industry in Nigeria?
Thank you very much. As you said, my name is Ololade. I'm the National Coordinator for the Cotton Cooperative Society in Nigeria. I'm also the coordinator for the CTG revamp, private sector stakeholders. Cotton in Nigeria. I was speaking to part of the people we're working on this together, Mrs. Ogunlesi, Ropontombo, and she said that it's a dream that its time has come. You mentioned that in the past, cotton used to be the CTG sector, so we're talking about the entire CTG now, we're not just taking cotton, used to be a major employer of labor. And in other climes, like you've mentioned, is still a major employer. And that's what we're working towards in Nigeria. We're driving towards opening up that sector and opening the eyes of both the private sector, the international bodies, and the government to see what we have. We're sitting on gold. That's why they call the cotton the white gold. We want Nigeria to be where they used to be, and even better, and we can get there. We're getting there.
Right, because it's quite interesting. I'm seeing this beautiful fabric you're wearing here, and that's not coming from here, basically.
No.
Yeah, so we're importing most of this.
Yes.
I see a lot of fine fabrics.
Yes.
All over the market, and they look really good.
They're quite good.
And you'd expect that we should be able to produce, some of this. So we need to get back to that big, beautiful time.
We are
at this
getting
point.
back.
So do you think, government is moving in the right direction, doing enough, when it comes to boosting, this industry?
Government in, government out. There's always been some kind of incentive, some kind of program towards the sector. But right now with this present government, because in the last government I was a prime anchor under the central bank anchor program. I was a prime anchor for Southwest, for cotton. They did, because of the prime anchor, we have people still holding fort. This government now, they've shown that willingness, the readiness to push the sector. We're talking about Nigeria first, policy. We're talking about diversification of economy. Let me tell you, I'm a cotton farmer. You know, I'm a farmer, I'm a proud farmer. So I'm a farmer, I'm a textile designer, I'm a textile maker, I'm a garment maker, I'm a fashion designer.
So you're big in that value chain.
I've done all of them, everything. So, and we've been talking to the government, and I can tell you for a fact that this government are not joking, they're not playing when they say they want to do the one diversification of economy. We've had stakeholders meeting, we've had several meetings with the government. I've had several meetings with the Minister of State for Industry, Federal Ministry of Trade, Industry, Trade and Investment, Senator John Eno, and I can tell you for a fact that, you know, they mean business. You know, the lot of work going on the ground, the lot of work, the lot of discussions going on with all the stakeholders, you know, a lot of factors, you know, will come to play for this to happen. There's easy accessibility to funds for the real farmers. When we're starting from the farming side, the real farmers, right, not the political farmers this time.
Right.
So we're having conversation. We've had meeting with the new MD of BOA on how farmers can be supported. You know, you talked about the import of all this textile or the garment.
Right.
We're working towards a sustainable program, a system whereby we're not just banning the border saying don't bring things in, you know, that's not totally sustainable in itself. But when we drive from the feedstock all the way to the garment, then we can actually stop the influx. Is the backward integration. The moment you control your feedstock, you control the entire value chain. The moment, and we're not controlling the feedstock from just the farm, we want to control from the seed. Right? So our target now is quality and quantity.
But I hear our cotton quality is one of the best in the world.
You can say that again and again and again and again and again. It is. It is. You know, we've not really explored especially our long staple. So potentially, we can match Egypt's cotton very well because of our soil type. You know, when this is properly done. So when we talked about the quality and the quantity, now we're talking more about the agronomic practices in terms of how we're planting the cotton so that we can meet up the global standard and then we can optimize and take advantage of what we have, like a long staple, you know.
All right, so let's look at consumption, you know, global cotton consumption. We're seeing China again.
Yeah.
They're there, the largest global consumer, about 34.49 million bales. That's what they consume. India is also there as the second largest consumer. Pakistan, there's significant textile industry, you know, in the country there. So we're still seeing, you know, big demand. But there's also this conversation about polyester. It seems polyester is threatening the position of cotton. You know, at this point, it seems to be or is that not the case?
You see, polyester, cotton is king. Right. So I studied textile designing, and I designed textile, and I, you know, create my textile. So I did textile through polyester, textile through cotton, I did through bamboo, I did through silk, I did through milk, banana fiber, and all that. They all have, polyester is big, to be honest, but cotton is still king. When you look at the overall market, look at the kind of textile or the fabric that is being used, majorly it's cotton. All uniforms, cotton, suit, blind, towels. So cotton goes beyond the garment, the finished garment that we wear. It goes beyond that. You know, it covers industrial usage as well, upholsteries, so many things. Now, in developing the cotton sector, before you even get to the garment, you know, you have the byproducts from the cotton, you know. So your garment comes at the last stage. You have your cotton, you have your cotton seed, you have the stuffing for mattresses and all that. You have, you know, the different byproducts, even the Naira note, that's from the cotton. So polyester is big, really big as well.
But it can't take the position.
You can't take that. You know, that's why they call cotton the white gold. It can't take position of cotton.
Fantastic. Oh, we'll keep watching the growth of that, polyester segment, because I feel that's also where, a real business, player can actually, get into.
Yeah, something I told people that CTG is an economy in an economy in an economy. So when you're talking about diversification of economy, in City there's still diversification of economy. So when you have the cotton from the farm and you have all the byproduct before you get to your yarn and all that. Now, when you get to textile, that's why you even diversify your economy. You come to your likes of polyester from gas, So you have your polyester, that other stuff. So when we're talking as the diversification of economy for Nigeria as a whole, polyester plays a very strong role. So that's why the CTG goes beyond just the cotton. Although we're starting with cotton, when we get to textile, we have that diversification of economy, which includes that polyester, as you said, is big. But cotton is still king anyway.
Cotton is still king.
So you now get to the garment.
All right, so, definitely we can't, run away from the business environment. Doing business right here, the business environment, has it improved? Have you seen improvement significantly, when it comes to, business production?
Since my engagement in a couple of months, I've been having several conversations. I will say that the environment now is more friendly for business. We're not where we want to be, but it's a gradual process. Excuse me. So I was talking to my people abroad, diaspora, and I was telling them, we need both the private sector and the public sector to work together. The public sector put out the policy, implementation. We have to hold them accountable for that from the private sector. It's all about narrative. People can say anything, we can say this and that, but have you really tried? So we keep trying. There's policy intervention. You have people that do that. Engage people, engage the government. We're putting together a private, big public sector conference very soon for the CTG stakeholders. And what it's all about is we want to hold the government accountable. The things that we believe are not working properly, in terms of the business environment, we're telling them that we will enable them. We will support the government. We will see to the diversification agenda. I remember the president said something in his interview during the campaign, 2022 NESG interview.
Okay.
He said something. He said, when he's looking for cities that understand or can be creative, bold, courageous, and innovative. For me, I tell the people around me, we have to be that people. We have to be that people that understand creativity, boldness, and we have to be courageous to move this economy to where it should be. So it is working hand in hand. We're not where we are. It's not about complaining. It's about working together with the government. That's how I see it.
Right. Not about complaining, working together. Good place to anchor it there. Thank you so much for coming today. That was Ms. Ololade Adene. She's the Managing Director, House of Dockers Integrated Services. Thank you so much.
Thank you for having me. Thank you very much.
Thank you. All right, we'll take a break now. When we come back, we head straight to the global space, find out what's driving markets right there. That's in a moment. Just stay with us. Well, let's find out what's playing out in global space right now. Willie Bong has the details. Great to have you, Will. Wearing cotton. Was it polyester?
Of course.
It's cotton. Right?
Well, cotton is really like, I was having a back-end conversation, behind-the-scenes conversation on this, and it was interesting to know what cotton can really do. The value chain of cotton is like, I was amazed. Like, I really want to be at the cotton factory right now.
Yeah.
I felt like I could be transported there.
Right.
Yes, like white gold right now. And I hope that the government will see potential in this and actually put the right policies for Nigeria to actually be at the top.
They see it, at this point, and they're pushing you know, to get our cotton production out there.
It will be fantastic for us to be ahead there. But you mentioned China is leading in cotton production. But China is everywhere. I feel like I got China everywhere today. I'm just wondering, when will China like take the back seat and allow us Nigerians?
That'll be interesting to see.
But I hope that, you know, soon Nigeria will be at the top of the list and see, not just in terms of potential, but in actual production and, you know, supply too, within ourselves and outside the country.
Fantastic.
And so let's see what's happening in the global space. We'll start with what to expect this week. We get it from the U.S. economy. Everything is happening. That's where the action happens. Updates on the Q1 GDP. We're going to be getting inflation data as well. And also consumer confidence data is expected. And this will offer insights into the U.S. economy's performance and inflation trends. Let's look at corporate earnings. That's one of the things we're expecting this week. Key tech and retail companies, including NVIDIA, Salesforce, and Costco, will be releasing quarterly results, and this will also influence the market sentiment. So let's look at the Federal Reserve. We're expecting a lot of communications from the release of the May minutes and speeches from the Fed officials. They will provide clarity on potential interest rate changes and economic policy, and this will definitely set the trend for other global economies. Now let's kick off with China. One of the stories I did mention, China is in the news this week. China appears to be drafting a new strategy to boost production of high-end tech goods. And this signals its push to remain a global manufacturing leader despite U.S. efforts to bring factories back home. And the plan is expected to succeed the Made in China 2025 initiative with a focus on advanced technology like chip-making equipment to avoid Western backlash. The campaign may adopt a different name. Officials are also shaping China's next 5-year plan starting in 2026, aiming to keep manufacturing share of GDP steady, challenging U.S.'s hope for a major economic shift in China. Now, still on China, Xiaomi has unveiled the YU7 SUV, claiming a 760-kilometer range, longer than Tesla's Model Y. The EV is expected to be priced between 250,000 yuan and 320,000 yuan, directly rivaling Tesla's Model Y, which starts at 263,500 yuan in China. Now, CT analyst projects strong demand with potential annual sales of up to 360,000 units. The YU7's official launch and pricing are set for July. Now, Tesla's Model Y, once China's second best-selling EV, now faces stiff competition as Xiaomi expands in the EV market. Now, shares of China's BYD fell 8.25% on Monday after the EV maker slashed prices on 22 models, including a 34% cut on the Seal hybrid sedan. The discounts run through June. If you're looking for one, catch it there. City analysts said the move boosted dealership traffic by up to 40% over the weekend, but investors worry about rising competition and a potential price war. Other Chinese automakers also dropped. Geely slid 7.3%, Li Auto 4.9%, and Shipping 4.2%. City expects strong sales from EVs under 200,000 yuan despite the pressure. Now we'll go to NVIDIA, which is set to release a lower-priced AI chipset in China, aiming to start mass production by June. That's the report that's coming in today. Now, the new chip, part of NVIDIA's Blackwell architecture, will cost between $6,500 and $8,000, well below the $10,000 to $12,000 H20 model limited by U.S. export rules. Now, designed with less power and simpler specs, it's based on the RTX Pro 6000D and uses GDDR7 memory instead of high-bandwidth alternatives. Now, Miniso shares we all know Miniso. The shares fell 18% on Monday after the Chinese retailer reported a 29% drop in quarterly profit, despite an 18.9% revenue rise to RMB rise to 4.43 billion. That's about $610 million. Now, adjusted net profit dipped 4.8% as operating costs surged, especially selling and distribution expenses, which jumped nearly 47% due to global store expansion. Now, while China's same-store sales improved, overseas gains weren't enough to offset costs. CEO Gofuye warns of a volatile macroeconomic outlook heading into 2025. Now, Argentina is close to finalizing a deal to export beef offal to China, with technical talks nearing completion, according to officials involved in the negotiations. Now, the agreement, driven by China's push to diversify food imports amid tensions with the U.S., could be sealed soon, with Chinese officials set to visit Argentina on June the 8th. China remains Argentina's top beef buyer, though its share of Argentina's beef exports dropped to 56.4% in the first quarter of 2025. Officials say lower Chinese prices earlier this year slowed shipments, but volumes are picking up again in May. Now we'll move on to see what France and Vietnam are up to. They're signing a deal for 20 Airbus jets and other cooperation pacts as President Macron visited Hanoi to boost ties amid U.S. tariff threats. Agreements included defense, satellites, energy, and vaccine cooperation. President Macron also reaffirms France's support for navigation freedom in the South China Sea. The visit comes as Vietnam faces U.S. pressure to buy American goods, raising EU concerns over losing ground in the key trade deals. Macron next heads to Indonesia and Singapore. Let's see what he's going to do there. Now we check in on the Eurozone, where the government bond yields rose on Monday after the U.S. withdrew its immediate threat of imposing 50% tariffs on European imports, easing investor concerns over a potential economic shock. Now, President Donald Trump agreed to extend trade talks with the EU until July the 9th, boosting market sentiment. Germany's 10-year yield climbed 3 basis points to 2.6%, recovering from Friday's 6.5 basis points drop. The more rate-sensitive 2-year yield rose 4 basis points to 1.8%. Now, Italy's 10-year yield edged up 1 basis point to 3.82%, supported by Moody's decision on Friday to upgrade the country's outlook to positive. Now, shares of German automakers rose Monday after President Donald Trump postponed a planned 50% tariff on EU imports to July the 9th. Mercedes-Benz and BMW gained over 2%, while Volkswagen rose 2.4% in early Frankfurt trade, rebounding from Friday's slump triggered by the initial tariff threat. Trump says he granted the extension after a request from EU Commission President Ursula von der Leyen, who confirmed both sides are ready to resume talks swiftly. Laddie, a lot of talks. I think we need to talk too, Laddie. We've got a trade to close. If you don't sign this contract, I don't know what's going to happen on Business Incorporated.
Well, Europe is on the front burner now for most of those tariffs. We'll see how it plays out later on when the markets open globally. Thank you so much, Will, for those details. And definitely we'll see the equities market right here in Nigeria that closed in negative territory last week. We'll see if we kick off this week.